Welcome to Wall Street Week, the show of record for long-term investing. I'm Gary Kaminsky.
And I'm Trish Regan. Another week of stock market records. How about that? U.S. Treasury Secretary Steven Mnuchin laying out an aggressive tax reform timeline with our very own Maria Bartiromo.
Tax reform is our #1 objective. We think it's absolutely critical to getting the economic growth. We need to make sure that the middle income gets a tax cut. We need to make sure that businesses are competitive with the rest of the world. There's trillions of dollars offshore that will come back, and this will create jobs, this will create investments, and we need to make sure our U.S. businesses are competitive.
Now, the Treasury Secretary did caution that any tax plan wouldn't have economic impact this year and that any growth wouldn't come until 2018. Our first guest this week is Morgan Stanley Wealth Management Executive Director Dan Skelly. Joining us now. Dan, the market is optimistic about a tax plan that is yet to be unveiled. Mnuchin has also talked about, with Maria, the hopes to have this plan passed in August. Are you starting to get worried that this could get bogged down and that the market is ahead of itself, Dan, because the expectations are that this would have been sooner rather than 2018 impact?
Sure. I mean, I think it's a great point, but keep in mind that it's coming on the back of a decade of having very little fiscal spending. So, yes, the market's a little bit ahead of itself potentially right now, and we could see some volatility maybe in the middle of this year, summer of this year. But we do think the tax deal gets done, and we think the market can actually grind higher afterwards.
Okay, so you think it's going to get done, and it doesn't necessarily matter quite when it gets done, as long as it's within a reasonable amount of time and as long as it happens.
Well, I think it probably does get done by the end of this year, and I think that is good enough for the market at these levels. That being said, as you know, it's only one component of some of the change we're seeing in Washington, right? So now we're also going to be on the lookout for infrastructure initiatives and potential changes to regulation. We're hearing a lot about some different changes in terms of the Fed chairman, supervisor, and some of the other regulatory bodies. We're going to see changes in leadership there.
So all of this would be good.
Exactly. It's only one component of all this change.
Let me ask about another component of this tax plan, and that's the effect it might have on retailers. The way it's currently being proposed in the House is that you would not have the opportunity to deduct your expenses that are coming from overseas goods. So to make that more simple, perhaps if you think about like a retailer like the Gap or something that's importing T-shirts from China, they would not have the ability to deduct the cost of those goods coming in from China anymore. And there's real concern in the retail industry, and I think about this from an investor's perspective with retail stocks, that it's going to decimate retailers and that you're going to see a lot of bankruptcies as a result of this plan if it's successful.
Sure. I mean, I think that's a huge risk for the space. The question is how much of it is priced in today. You've already seen a pretty dramatic correction in a lot of the retailers in the last couple of quarters. That's been on, of course, the derating in valuations on this tax risk, but also on some of the fundamental pressures you're seeing in the space. Huge market share losses to e-commerce, as an example. We've also seen a lot of wage growth in the last couple of quarters. That has been very bad for margins in that space because it's particularly labor intensive. So it's not just the risk and the valuation risk around taxes and some of the changes we may see there. It's the fundamental pressure you're seeing on retailers, and we've actually tried to avoid a lot of that space.
Dan, I want to talk about the portfolio because obviously I was very excited. You know, Dan's portfolio is one of the best kept secrets within Morgan Stanley. The proprietary portfolio, they run billions of dollars, and it's really outperformed the S&P on a consistent basis. But I also want to go back to one thing else from Mnuchin this week, because I heard the one thing that stood out this week was that the Secretary of Treasury did say that this is a mark-to-market administration. Now, obviously, the stock market has reflected very strong on the mark-to-market, so it has been since the inauguration. But is that something that you heard about this week? Is that something to be concerned about? Because we all know the stock market doesn't go up every day.
Yeah, it's like a mark-to-Twitter market almost, right? It could be even more tactical than that. My opinion is as follows. Yes, there's a lot of focus on the White House right now and some of the leadership there, but keep in mind we had a dramatic change in the House and the Senate. I think that's the aspect that's not being talked about enough, and the fact that we have a Republican-controlled leadership broadly today is why the VIX is so low. I think volatility is low because the market's telling you for the first time in 10 years, we've got the highest probability of getting some pro-growth policy done. So yes, I think the White House is trying to live up to its expectations, and they're pushing expectations higher. But keep in mind that they might have some pretty serious support from the House and the Senate.
All right, given the way you see the world, because I talked about the portfolio, give us one stock, your best investment idea right now when you look at the changes that are going to take place, both from a fiscal and a monetary standpoint, as well as the infrastructure spending. What would be the one investment that you think is your top investment?
So on a policy perspective, we like Wells Fargo a lot, okay? And so we started adding more to Wells last September in the heart of their account scandal. We saw a stock trading at 11 times earnings with a 3.5% dividend yield at the time. Now, of course, Wells has rallied post the election with the rest of the financial space, but it still hasn't regained its premium to the large cap banks. Go back 10, 15 years, Wells has typically traded at a 10 to 20% premium to the banks. Today it trades at a 10% discount. And the reason for which is, yes, it's rallied, but the whole sector has rallied as well.
Are you confident in the new management?
We are. We're confident that they've made the changes to management that will matter for their earnings growth going forward and to regain their brand equity. But going back to your point about what's a name that could get affected by policy, we talked a moment ago about regulatory changes. I think the more the market sees regulatory changes to the financials, that's a name that will shoot higher to the upside. And also it's just interest rates, right? So it's fundamentals and policy.
All right, it's been a great 2 months for the stock market. Expectations for total return equities this year?
Yeah, so we actually think equities are not overvalued. We think there could be 10 to 15% upside over the next 12 to 18 months. And the reason for that is we're seeing an economic recovery fundamentally. As you know, we had a pretty nasty old economy industrial recession. We came out of that last year. If you couple that with the earnings recovery that we're seeing and the potential for policy improvement, fiscal spending, infrastructure initiatives, deregulation, we think that's a cocktail for 10 to 15% upside.
All right, optimism continues.
I like it.
Dan Skelly, thanks for joining us. Wall Street Week, we'll be right back.